Important update, and this one really matters if you're counting on your tax refund this year. The IRS has officially locked in the start of tax filing season, but here's what most people don't realize yet. This year, filing your taxes the same way you always have could actually work against you. Filing too early, filing without understanding what changed, or filing based on last year's rules. Any one of those could delay your refund or trigger issues you weren't expecting. And the frustrating part? Some of the new changes can help you, while other changes quietly cancel out those benefits if you're not careful. That overlap is where people get caught. So before we go any further, I'm curious, when tax season opens, are you someone who files immediately, or do you usually wait a bit? Drop it in the comments. I always like to see how people handle this. Now let's get into what's actually happening. January 26th is the first day the IRS will officially accept and begin processing tax returns for the 2025 tax year. That marks the start of the 2026 filing season. On the surface, that sounds normal, but what makes this year different isn't the date. It's what's going on behind the scenes. We're dealing with new tax laws, major changes to deductions and credits, a reduced IRS workforce, and a shift in how refunds are paid out. All of that combined makes this filing season more complicated than usual. And for many households, this isn't just paperwork. For a lot of people, their tax refund is the largest lump sum they receive all year. It's rent money, it's catching up on utilities, it's paying down a credit card, or finally building a small emergency cushion. And with food, housing, and healthcare costs still high, the timing and accuracy of that refund really matters. One of the biggest reasons this season is different is the tax law signed last summer by President Donald Trump, known as the One Big Beautiful Bill Act. This law changed deductions, credits, and income thresholds, and those changes apply to the return you're about to file now. Some of these updates sound simple on paper, but in real life they add complexity. For example, there are now brand new deductions for workers who earn tips, employees who receive overtime pay, and even people with qualifying car loans. Workers who earn tips may be able to deduct up to $25,000. Overtime pay deductions can go up to $12,500, and auto loan interest deductions may reach $10,000. That sounds great, but here's the issue. Employers didn't update withholding tables after this law passed. That means many paychecks didn't reflect these changes correctly. So a lot of people had more tax withheld than necessary without realizing it. Yes, that could mean a larger refund, but it also increases the risk of reporting errors. If your W-2 isn't aligned correctly, or if a deduction isn't documented exactly right, your return can get flagged. And this year, that matters more than ever, because the IRS is entering this filing season with about 25% fewer employees than last year. Processing teams are smaller, customer service units are thinner, problem resolution departments are stretched, so mistakes that used to take days to fix could now take weeks or even months. That's why tax professionals are saying accuracy this year needs to be closer to 110%, not just good enough. Another big update is the standard deduction. It's now $15,250 for individuals, $30,500 for married couples filing jointly. That alone could significantly reduce taxable income for many people. The child tax credit has also increased to $12,200 per child, which could make a real difference for families. And then there's the SALT deduction, state and local taxes. The cap jumped from $10,000 to $40,000, at least through 2029. This mainly affects people in higher tax states and middle to upper middle income households. Some families earning between $200,000 and $500,000 could save around $1,200 just from that change alone. The IRS says these updates are designed to provide targeted relief to working families, seniors, and middle-income earners. But here's where things get tricky. Even if IRS systems are updated, fewer staff means slower fixes when something goes wrong. And there's another major change most people aren't paying attention to yet: how refunds are paid. The IRS is moving away from paper checks. Last year, nearly 10 million people still received refunds by mail. Going forward, direct deposit is now the expected method in most cases. If you file without bank information, the IRS may send you a letter asking for it, and that alone can delay your refund. Paper checks can take 6 weeks or longer. Direct deposit usually arrives within about 21 days, assuming everything is correct. So if you've avoided direct deposit in the past, this may be the year to reconsider. Now, here's why waiting a bit can actually help you. Many credits require documents that don't arrive in January. Energy credits, electric vehicle paperwork, solar and home efficiency upgrades. Retirement contributions also come with updated limits and phase-outs that are easy to miscalculate early. Last year, the IRS saw a surge in amended returns because people rushed to file and later realized something was missing. And amended returns almost always mean delays. You still have until April 15th to file. And if you need more time, you can file an extension until October 15th. Just remember, an extension gives you more time to file, not more time to pay. This filing season isn't a race. The rules changed, the systems changed, and the staffing changed. Taking your time, double-checking your forms, and making sure you actually qualify for the deductions you claim can make a huge difference. January 26th is just the opening day. It's not a deadline, it's not a competition. Preparation and precision matter more this year than ever.